Welcome back, everyone. Today, we're diving into a fascinating story about how just one single political headline can send massive shockwaves through the entire financial system. It's a story about tariffs, it's about credibility, and really, it's about a domino effect that shows just how connected and maybe how fragile the market really is. All right, let's get right into it.
If the last few years have taught us anything, it's this. We are absolutely in an era where politics, not just boring old economics, are driving the markets. From tensions overseas to trade fights, what happens in the halls of power now directly dictates where the money flows. And last week was a total masterclass in this exact idea.
And here it is. This is the event that lit the fuse. The U.S. Supreme Court came out and ruled that the existing tariffs, which, by the way, have pulled in about $175 billion, were imposed illegally. And the response? It was immediate, defiant even. A proposal for a brand new, across-the-board 10% global tariff with threats to crank it even higher. Just a massive showdown between the courts and executive policy. So, okay, with the country's entire trade policy suddenly thrown into legal chaos, where did investors immediately put their money? What was that first knee-jerk reaction to this geopolitical bombshell? The answer came fast: the debasement trade. Now, this is a strategy that's built on one single core idea, that this kind of political infighting and chaos fundamentally makes the US dollar weaker. The market's first move wasn't about stocks. It wasn't about bonds. It was a straight-up bet against the dollar itself. And you can see the results of that trade right here. When investors start betting against the dollar, they rush into hard assets. In the past week, we saw a really significant rebound in commodities that are priced in dollars. Silver, copper, gold, even the more speculative metals like platinum and palladium, they all jumped. It's the classic playbook for a weakening currency.
Okay, so commodities had a good week, great. But this political clash, it creates a much bigger, much deeper problem. If we look beyond the short-term market moves, who is the real potential loser in this tug of war between the Supreme Court and the White House?
The real damage here isn't really financial, it's reputational. It's the US dollar's credibility. See, when a major policy can be put in place and then years later be declared illegal, it damages the world's faith in the stability and predictability of the whole US system. This kind of uncertainty just chips away at the dollar's status as the world's go-to reserve currency. And what's so crucial to understand is that this isn't a new problem. This event is just accelerating a trend that's been going on for years now. The dollar's share of global foreign reserves is already at a century low, down to around 40%. This whole process of de-dollarization gets a huge push from events exactly like this one. But here's where things get a little weird. The bond market, the so-called smart money that's usually the first to panic, it barely moved. It was calm. So why, in the face of this massive political uncertainty, did the bond market seem so, unbothered? Well, the answer seems to lie in prediction markets. Traders are giving it only a 19% chance that $175 billion in tariff money will ever actually be refunded. So the bond market is calm because it basically believes nothing is going to change and that money will never be returned. It's treating the whole ruling as just noise, at least for now.
But look, this whole tariff drama isn't happening in a vacuum. The market is also being forced to price in another major geopolitical flashpoint, one that's feeding into a totally different and, frankly, more worrying investment strategy. I'm talking about renewed tensions between the US and Iran, especially around the critical Strait of Hormuz. Prediction markets are now placing the odds of a US attack on Iran by mid-March at nearly 50-50. That's basically a coin flip, and that is a huge risk factor that has investors on edge. And that specific risk is fueling what's known as the stagflation trade. This is a strategy that's pretty much designed for a worst of both worlds scenario, an economy that's slowing down, but where prices just keep on rising. Let's connect the dots here. Geopolitical tensions rise. That pushes oil prices up. They're already up 15% this year. Higher energy costs keep inflation sticky, even if the economy is slowing. And the result? The stagflation trade was the best performing strategy over the last month, up a solid 5%. So we have these major external shocks rattling the markets from the outside. But while everyone is watching geopolitics, a totally different kind of problem is brewing right under the surface, from inside the US stock market itself. The issue is a stealth bear market,
a hidden downturn in the very stocks that have been holding up this entire market rally, the so-called Magnificent Seven. The leaders of the bull run are now quietly bleeding out.
And I mean, the numbers here are pretty stark. We're seeing Microsoft down nearly 30% from its peak. Amazon and Tesla have both corrected over 20%, and Meta isn't far behind. By any technical definition, several of the market's most important stocks are in a bear market, even if the broader indexes don't really show it yet.
So, why hasn't the S&P 500 crashed? Well, it's because this weakness is being cleverly masked by something called sector rotation. As money flows out of these huge tech stocks, it's flowing into cheaper, more cyclical parts of the market. Think energy and industrials. This rotation is propping up the overall index, hiding the trouble in its biggest companies. The correction in big tech, that's a known unknown at this point. But what if the next major risk is something almost no one is talking about? A hidden danger that's connected to the single biggest investment theme on the planet, artificial intelligence. And that brings us to this concept of shadow debt. Think of it like a corporate credit card that doesn't show up on the main statement. It's off-balance sheet financing, where major tech companies borrow enormous sums of money, often through private equity, to build all these AI data centers, without that debt ever appearing on their official books. And right here might be our canary in the coal mine. Blue Owl Capital, a private equity firm that is deeply involved in this type of AI shadow financing, has seen its value just collapse by over 50%. This could be the first sign of serious stress in the hidden plumbing of the whole AI boom. So, while the market is busy juggling geopolitical shocks and these internal rotations, the biggest risk might just be the one nobody sees coming. Is the immense off-the-books debt that's being used to fund our AI future? Is that the next shoe to drop? That's the question to keep in mind. Thanks for tuning in.